Hi, this is Ben, back for another educational Flash episode. I have an idea that I think you guys will like. It's pretty exciting stuff. But first, let's have a look at something I did in June, okay, called Unity Software. It's a long play that I covered in a Flash episode called Creative Opportunity. And at the time, the stock was at 26 and it's now trading at 46, right? So it's like almost an 80% move in 3.5 months. And that's just for the underlying. And I'm not going to bore you with all the options math, but safe to say it was a pretty nice trade, especially if you roll it forward like I did, because I think there's still upside in this one. Anyway, let's see what is going on with these markets, right? So the indices are still kind of smashing into new highs with expectations of a more dovish Fed. We're going to see tomorrow when the FOMC meeting happens, what goes on. But basically, the market is just pricing in multiple rate cuts. So is that view justified? Well, the economy is kind of showing a mixed picture right now, lackluster growth, and the labor market is especially weak. However, inflation is starting to creep in, right? As companies are really passing on tariff costs to the consumer. We've seen more and more companies like Home Depot start to do this, and that could be a problem. The latest inflation data that came out was in line with expectations. Yeah, sure, and it's still below 3%. But CPI is now sitting at a 7th-month high, so there's that, right? The FOMC meeting is actually going to happen before this episode airs. And at this point, the 25 basis point cut is a done deal, right? We'll see what the forward-looking view is. That is really what's going to kind of have an impact on the market, if any, especially if there's a surprise. And I'm not going to try to predict how the market will react. Okay, there's no point. And it really doesn't matter because we are long, short, agnostic portfolio managers. So either way, more likely, we'll see a pickup in volatility. But if there is some type of surprise, we can be in for some volatility potentially next week or later this week, next week. All right, then. So what am I looking at these days? Going into year end, I want to have some more long exposure in small cap tech with just massive growth potential, a little more speculative plays. And I have a name that fits neatly into that category, and it will go into my book nicely. And the stock I'm zooming in on is Ondas Holdings. Okay, ticker is ONDS. It's trading around $6 right now. It's a $2 billion market cap company, and they operate through two segments, really. They have their Ondas network, and then they have their autonomous systems segment. And the network segment represents 3/4 of the revenue stream, and it's just operating on a larger scale. And it's just nice to have a bit of extra kind of cushion. Their flagship service is something called FullMAX Software Defined Radio Platform, and it provides mission-critical industrial wireless communications. And yeah, I know that sounds pretty vague, but for examples, providing network service solutions and security to commercial and passenger rail operations, self-driving vehicles, energy, space, and aviation applications. So it's not your typical networking stock for sure. It's a little more niche and kind of industrial government oriented. And they have several government contracts utilizing their FullMAX SDR platform at this time that just kind of provide us more steady income stream. That said, I am more excited about their autonomous drone business. Right, so it's not just for defense, and it's not the typical drones, right? You'll see buzzing around. These are industrial drones, and they're really handy, especially monitoring stuff that goes on in zones that are hard to get to, which kind of think about like growth, like weed growth in agricultural growth around railroad tracks, things like that, and also obviously military. And there's really big potential for this market segment. And just the other day, Germany approved $1.2 billion worth of drone purchases from Israel. And in June, this company, Ondas, secured $14.3 million order from a leading defense contractor. and that was for its Optimus drone systems. And it represents their largest purchase order for that application, actually. So they're just becoming more and more on the map. Now, they have had some issues, heavy cash burn, so they continue to operate at a net loss. So that's been a bit problematic. But also, they, in order to compensate for that, they have been diluting the shares to provide operational capital. So clearly, there's some headwind, but that's also the stock is trading where it's trading. But I think the revenue per share is climbing, right? And EPS has been steadily improving. So I think there is room for getting into the green here in the next couple of years as far as earnings goes. And the stock price is going to reflect that. It's already starting to reflect that. The stock has had a massive move this year. And I don't mind jumping in on this momentum for a small cap stock. And, you know, the way we structure it, even if it kind of stalls out for a while, which I think it could, that's fine. Speaking of growth, EPS growth is actually clocking in at 54% for this fiscal year. And they have earnings in mid-November. Okay, so with all that's going on, how can I set this up with options? Okay, with limited risk, but that carries this massive upside potential. So let's have a look. The classic kind of calendar ratio spread tends to work well in these situations where we're going to be long more calls than we're short. And it provides pretty much the most flexibility, and also gives me an opportunity for massive potential to the upside straight out of the gate. And especially with a high IV or implied volatility name like this. So if you're looking at the chain, you can buy 40 of the at the money December 6 strike calls at 160. That's a current mid quote. That's going to cost $6,400. And then also selling 30 of the October 750 strike calls at 50 cents. That gives me a credit of $1,500. So I'm essentially lowering my cost basis by over 20% by doing this, while still maintaining just straight up upside, because I'm net long 10 calls, right? So that makes the total cost and also max risk $4,900 for this setup. And then when October expires, I can short it again. I can actually short it a few times to maximize my kind of credit harvesting, depending on the stock price at the time, obviously. And like I mentioned, I think there's a good chance that maybe we'll see a pullback in the overall market and in kind of stocks like this. So I'm pretty confident I'll capture my $1,500 credit in October. And then let's say I don't short it again. I just sit there happy, long all my calls over earnings in November. And, you know, they get a new contract, something like that. And the stock rips up to the 2021 highs of $12. Then the long calls will have a profit of 12 minus 6 versus the strike, minus the cost of 160 times the 40 contracts times the multiplier of 100, right, is $17,600. Plus, you get a $1,500 credit for your short. So you have $19,100 in profit, okay, on a $5,000 spend, pretty much. So it's close to a 4-to-1 reward risk. And that's if I don't add any more short exposure along the way. And even if this stock doesn't really get going, it kind of stalls out at the short strike at 750. I'll still make some money. It's a full loss if it's below, if the stock is below $6 by December, and I just don't do anything about it. But that's a risk I'm willing to take because the sky is the limit here on this one. That's all I got for now. See you on the other side of the rate cut. Over and out.